Okay, so you want to own a McDonald's. You have seen the line at the drive-thru. It never seems to end. You have watched that restaurant stay full in a recession, full through a slow winter, full through everything. You picture the golden arches lit up at night, your name on the operating agreement, a machine that runs while you sleep, a business people drive to on autopilot. They pull in without ever deciding to. It feels like the safest bet in all of franchising, familiar, everywhere, proven for 70 years. McDonald's serves around 68 million customers every day. It operates in more than 119 countries. Nothing on earth looks more like a sure thing. The arches alone seem to promise it. Safety, scale, a line that never ends. Sounds simple. It is not simple, because the first real number is $2,728,000. That is the top of the range. It is what one traditional restaurant can cost to open. And the most important part of that money, you cannot borrow. Most people never get past this number. So let's start where McDonald's starts, with the price of the table. Here is the number everyone quotes. The McDonald's franchise fee is $45,000. That figure is accurate. It is also almost useless as a planning number, because $45,000 is not what it costs to open one. Look at the 2026 franchise disclosure document. The total initial investment is listed there in black and white. It runs from $1,470,500 to $2,728,000. The famous fee is a rounding error inside that range. So where does the rest of the money go? Equipment alone runs from $325,000 to $1,550,000. That is the fryers and the grills, the freezers and the drive-thru systems, the digital ordering screens along the wall. The first 3 months of rent can reach $313,100. That is due before you sell a single burger. Then comes signage, seating, and decor. Then opening inventory and training travel. Then working capital to survive the first slow months. But none of that is the real gate. Here is the real gate. McDonald's will not even read your application first. Not until you meet one condition. You must hold between $500,000 and $750,000 in cash. Liquid, non-borrowed funds. Not a loan, not the equity in your house. Money you already have. Money you can afford to lose. On top of that, your net worth must clear $1 million. And money is only half the entry price. The other half is time. Before you are approved, you train. Not for a weekend. For 12 to 18 months. You work the counter and the grill yourself. You attend McDonald's own school. They call it Hamburger University. It has trained operators for decades. You learn the system from the floor up. You learn food safety and labor and margins. There is no shortcut around this year. Only then are you considered for a store. It was not always this steep. In the early decades, the deposit was tiny. A franchisee could start with as little as $950 down. That deposit became the down payment on the land. So the operator financed McDonald's own property. Today, that door is bolted shut. Now you bring $1 million in net worth just to knock. Think about what all of this does. The $45,000 fee does not screen you at all. The cash and the training screen you. They remove everyone who needs a loan to start. They remove everyone who cannot vanish for a year. What is left is a specific kind of person, someone who already has real money, and someone willing to convert it into a job. That is the first thing McDonald's is buying here. Not your ambition, your liquidity, and a year of your life, up front. And most operators cannot pay all cash, so they finance a large part of it. They borrow $1 to $2.5 million. That debt lands on day one. You open the doors already owing. The clock on repayment starts immediately. So the $45,000 fee isn't the price of entry, it's the price of the application. You have wired the money. You have cleared the gate. Now look closely at what you actually bought. You have paid. You have a McDonald's. So what part of it is actually yours? The equipment is yours. The signs and the seating, the decor, the fryers, the kiosks. You paid for all of it, and you will pay again to replace it, and again to remodel it, whenever McDonald's tells you to. This is one of the quiet traps of ownership. The remodels are not optional. When McDonald's launches a new store design, you fund it. That can mean hundreds of thousands of dollars. You spend it on a building you do not own, and the returns on that spend are not promised. One failing Iowa operator learned this directly. When he bought his stores, remodeling them all was required. That reinvestment never really stops. The agreement expects it, year after year. The land is not yours. The building is not yours. McDonald's owns or controls both. So from your very first day, something strange is true. Inside your own restaurant, you are renting the floor. You are renting it from the company on your sign. Read that again. This is not a quirk of your particular deal. This is the deal for almost everyone. Look at the system as a whole. McDonald's owns roughly 45% of the land under its restaurants. It owns roughly 70% of the buildings. The rest it controls through long-term leases. It holds those leases, then passes them down to you, and the arrangement carries hidden weight. As the operator, you cover more than rent. You carry the property insurance. You carry the taxes on a building you do not own. Those obligations transfer to you quietly. Most new owners never see them coming. The scale of this is not small either. In 2025, McDonald's had 13,559 total U.S. units. Of those, 12,887 were run by franchisees. Only 672 were company-owned. So the operator paying rent is the normal case. 12,000 versions of the very same arrangement. Now look at the clock on it. The term you sign is generally 20 years. And at the end, you have no right to renew, no right to extend. A new term is offered at McDonald's discretion. It depends on your compliance. It depends on your contribution to the system. And think about the leverage that creates. You spend 2 decades building the store. You bring it to the very end of the term. Then the decision to continue is not yours. It belongs to the company that owns the ground. If they say no, the work simply ends. Your years become their real estate. So you did not buy something you can hold forever. You cannot simply pass it down. You bought a right to operate on land you do not own for a fixed window, ending when they decide. You didn't buy a business. You signed a 20-year lease with a very large deposit. So if the building isn't your asset, the money must be. Let's follow that money. Money enters a McDonald's in layers. Start with the layer everyone sees. Layer 1 is the front counter. People walk in, they order, they pay. Simple and familiar. It is also, increasingly, the smallest layer. Layer 2 is the drive-thru. This is the volume engine of the modern store, and the volume is enormous. A U.S. McDonald's now averages $4,057,000 in yearly sales. That is the 2025 average unit volume. It climbed from $3,966,000 in 2024, and from $3,797,000 the year before that. The trend line only points up. That is the highest average of any burger chain in America. No competitor comes close, and most of that volume never comes inside. The drive-thru does the heavy lifting now. Cars stack up at lunch and dinner. The line you pictured is the business itself. The dining room is almost an afterthought. Layer 3 is where the real margin lives. And it is not the burgers. It is the drinks and the fries. Think about a soft drink. It is mostly syrup, water, and ice. It sells for a couple of dollars. Now think about fries. They are potato and oil. These 2 items carry the entire store. They sell at a markup a beef patty can never reach. A store selling only sandwiches would struggle. The combo meal exists to sell you the drink. There is a newer layer now too, the app, the delivery orders. McDonald's has poured money into digital ordering. It pushes deals through the phone in your pocket, and delivery brings a fresh stream of sales. But it brings a fresh cost with it. The delivery platforms take a commission on every order. That commission comes out of your margin, and you still owe rent on those sales. You still owe the royalty. You still owe the ad fund. The order arrives through an app. The fees arrive all the same. Here is where it gets interesting, because there is a 4th layer of revenue, and this one does not flow to you at all. Remember how your rent is charged? It is a percentage of your gross sales. Depending on the site, that is roughly 8% to 15%. It applies to everything the store rings up, so every extra dollar you earn does something. It automatically raises the rent you owe. Sit with that for a second. Your busiest, most profitable day is also your landlord's best day. It is wired directly into the lease. You cannot separate the two. The final revenue stream isn't yours. It's the rent your own success pays to your landlord. Now watch what every one of those dollars must survive before any of it becomes yours. The sales are in. Now the ledger takes its cut, line by line. Every single day you are open. Labor comes first. In a well-run store, wages take roughly 30% of sales. That is the crew and the shift managers. The hiring and the training, and the constant turnover fast food never escapes. Site costs come next. Rent, utilities, maintenance, repairs, roughly another 30% of sales. The lights stay on all day. The equipment runs from open to close. It breaks, and you pay to fix it. None of that waits for a good month. Food is the 3rd drumbeat. The beef, the buns, the oil, the cheese, and the packaging around everything. Roughly 30% again. Add those 3 together now. You have already spent 90% of the store's sales. 90 cents of every dollar. Gone. Before you count a cent of profit, watch what's left. Roughly 10%. And that final slice is not clean profit. Out of that slice come your franchise fees too, because McDonald's takes more, off the top. It takes a royalty of 4% of gross sales. Then it takes another 4% for advertising. That is a combined 8% of every dollar, taken before you buy a single potato. Now stack the rent on top of that. Add the royalty and the ad fund together. Between them, McDonald's can pull 16% to 24% of your gross, all of it before your own costs begin. So look at a strong store. Say it does $3 million a year. Industry margins put its earnings near $499,000. That is before interest, taxes, and depreciation. On paper, it looks like a healthy number, but you still owe the debt. You borrowed $1 to $2.5 million. That loan payment comes out of the $499,000. It does not come out of the sales. It comes out of what is left, after everyone else is paid first. And notice who never carries this risk. McDonald's does not pay your loan. It does not pay your crew. Its fees are calculated off the top line. Your profit is whatever survives at the very bottom. So that 10% is thinner than it sounds. First, the loan payment takes its share. Then income tax takes another share. Then any surprise repair takes more. A single broken walk-in freezer can erase a month. The margin looks comfortable on a spreadsheet. It rarely feels comfortable in the store. You take home the 10th. McDonald's takes its cut every day, off the top, before you even unlock the doors. But the cut itself is not the trap. The trap is how the cut is designed to grow. Here is the mechanism that decides who wins. Over 20 years, it settles everything. McDonald's financed the land long ago. Long-term loans, fixed rates, at old prices. So the company's cost of holding that ground is frozen. It does not rise with the years. It barely moves at all. Your rent moves. Your rent is a percentage of your sales. So consider what inflation does over time. It lifts every price on your menu board. And as your prices rise, your rent rises with them. This design goes back to the very start. In the early days, the markup was explicit. McDonald's leased a site, then subleased it to you. The rent it charged you carried a 40% markup, a markup over its own combined payments, and a percentage kicked in above a base. Once your sales crossed a line, rent climbed again. Follow the two lines side by side. Their cost stays flat. Your payment climbs every year for the length of your term. That split is the genius of it. Fixed costs for them, variable payments from you. Prices rise across 2 decades. Your rent inflates as a share of the store. Their expense stays right where it was. Look at the two sides plainly. On its franchised revenue, McDonald's keeps enormous margins. The rent and royalties arrive almost pure. The company carries almost none of the cost. You carry the food, the labor, the risk. You live on the last 10%. They live on the first cut. The same dollar means two different things. To you, it is survival. To them, it is a landlord's yield. And here is the trap almost nobody sees coming. The better you run that store, the worse this gets. The lease becomes more valuable, not just to you, to McDonald's. You are pouring your years into an asset you do not own, an asset you cannot keep past your term. Then there is the leverage under all of it. Your right to operate is tied to the lease. Break McDonald's standards, and something shifts. You are not merely a struggling operator now. You are a tenant in default, and a tenant in default can be removed. And leaving is not simple either. You cannot just sell to anyone. McDonald's must approve your buyer first. So a struggling owner has few options. Former operators describe the usual path. You sell to another franchisee if you can. Then you pray the debts get covered, and you hope to walk away with something. Filing for bankruptcy is worse. It hands control to the courts and the company. The exit door is as narrow as the entrance. The lease is the leash. This is legal. This is normal. The lease was never your protection. It's the leash. And McDonald's holds the other end. And none of this was improvised. None of it was luck. One man designed it, deliberately, 70 years ago. First, the beginning. McDonald's started in 1940. Two brothers opened it in San Bernardino, California, Richard and Maurice McDonald. It was a simple drive-in at first. Ray Kroc arrived later, in 1954, as a franchise agent. He bought the company outright in 1961, but Kroc had a problem before that. In the mid-1950s, McDonald's was barely making money. Kroc collected a royalty of only about 1.4% of sales. It was not enough to fund expansion. He bore the cost of training his operators. He bore the cost of policing them. The math simply did not work. Then, a finance man looked at the model. His name was Harry J. Sonneborn, and he found the flaw. Sonneborn had come from a company called Tasty Freeze. He told Kroc something that reshaped everything. "You are not in the hamburger business," he said. "You are in the real estate business." This part explains everything that came after. In 1956, Sonneborn set up a new entity. He called it the Franchise Realty Corporation. The plan was elegant and simple. McDonald's would acquire the land and building for each site. Then it would lease that site to the operator, at a markup, plus a percentage of sales. The effect was immediate. Rent began flowing the moment an agreement was signed. It arrived before the first burger sold. No more waiting on slow royalties. McDonald's had become a landlord with a captive tenant, and Sonneborn went further still. He needed capital to expand faster. So in 1961, he raised it in an unusual way. He secured a $1,500,000 loan from 3 insurance companies. It ran 15 years, at 7%. The price was steep. McDonald's gave up 22.5% of its equity, but it got the fuel to keep buying land, and each purchase fed the next. A new store meant new rent. It also meant a new piece of land. That land had value on the books. That value helped finance the next store. So the machine paid for its own expansion, one restaurant at a time, across the country. This was the virtuous cycle. From McDonald's side, from the operator's side, it looked different. Sonneborn later explained it plainly to Wall Street. They were not truly in the food business, he said. They were in real estate. The 15-cent hamburgers had one job. They were the greatest producer of revenue, and that revenue was what tenants used to pay rent. Kroc disliked how blunt that sounded, but the model never left. Sonneborn became McDonald's first president. He served from 1959 to 1967. Then the two men fell out completely. Sonneborn thought a recession was coming. He wanted to stop building new stores. Kroc wanted to keep expanding, hard. They stopped speaking. Then Sonneborn left. The real estate machine he built stayed behind. He was proven right about one thing. His model outlived every argument they had. It runs the company to this day. Decades later, it was dramatized on film. In 2016, the founder told this story. An actor delivered Sonneborn's famous line on screen. "You are in the real estate business." Today, the numbers are staggering. The real estate sits near $37.7 billion on the books. By some estimates, it is worth $42 to $45 billion. It represents roughly 99% of the company's total assets. The rental income alone runs about $7.5 billion a year, and the strategy compounds in downturns. During the 2008 crash, McDonald's leaned on it hard. Property was cheap, burger sales were soft, so the company bought more land while others sold. McDonald's doesn't sell you a franchise. It sells hamburgers so that you will pay its mortgage. So what happens when this model turns on an owner? Here is exactly what that looks like, with real numbers. Consider Brown Customer Delight Group, BCDG for short, a McDonald's franchisee in central Iowa, based around Des Moines. This was not a careless operator. He had done everything the system encourages. He sold an earlier set of stores in Minnesota. He reinvested the money. He bought in bigger. He remodeled everything the agreement required. At its peak, BCDG ran 10 McDonald's locations, all across the Des Moines market. Watch how fast it goes. The sales began to slide. In 2015, the company's sales fell hard. They dropped by $4,500,000 in a single year. That same year, BCDG recorded a loss. It was just under $900,000. So why did the sales fall? BCDG named the cause in its own filing. Rising competition from other chains. Yes, but also something closer to home. McDonald's itself was building new restaurants nearby, and those new stores pulled sales from BCDG's existing ones. This is the part most owners never picture. You have no exclusive territory. Nothing stops your own franchisor from expanding. It can open a new McDonald's down the road, and when it does, those sales are gone. They come out of your store, not out of theirs. You have no say in the decision. BCDG tried to survive it. It sold 4 of its stores. It was trying to stop the bleeding. It shrank from 10 units down to 6. But the debt did not shrink with it. By the time it filed, the numbers were grim. It reported $6,700,000 in assets. It reported $15,600,000 in liabilities. The gap between them was the ending. Then came the final move. McDonald's acted to terminate the agreement. Within days, BCDG filed for bankruptcy, and BCDG was not alone in its distress. Around that same time, analysts surveyed franchisees. The Nomura Group gathered their private views. One operator described a system in deep trouble. He estimated that 30% of operators were insolvent. Another said the model was near its end. These were not outsiders throwing stones. These were the people running the stores. The forms did not lie. Many owners were quietly drowning. The operator did not fail from laziness. He did not fail from neglect. The design placed a competitor across the road, and that competitor was the franchisor, the same one whose sign he had spent years lighting up. The competitor that killed them wasn't a rival chain. It was McDonald's, opening a store down the road. So after all of that, think about the decade behind it. The early mornings and the late closes. The crews hired and trained and lost. The stores remodeled on demand. The loans serviced month after month. After the millions. After the remodels. After a decade of work. What did BCDG actually own? Let's go back to the very beginning. Back to the dream. Your name on the operating agreement. The drive-through line that never ends. The machine that seems to run itself. Now you know the true shape of it. You paid up to $2,728,000 just to enter. You brought $750,000 in cash you could not borrow. You gave a year of your life to training. You bought the fryers and the signs and the seats. But you did not buy the land, and you did not buy the building. You signed for 20 years, with no right to renew when it ends. You sell the burgers, but the burgers were never the point. The burgers exist to generate the rent, and that rent flows to one place, to the company that owns the ground beneath you. At a cost they froze decades ago, while your payment rises every year you succeed. You spent your best years on that store. You worked the counter yourself for a year before you owned it. You improved an asset you can never keep, and then the risk sharpens. The moment you slip out of their standards, everything changes. The lease that once felt like security turns. It becomes the exact reason you can be removed. And here is the strangest part of all. From the outside, none of this shows. The store looks successful. The line looks endless. The brand looks unbreakable. And in a sense, it is unbreakable. Just not for you. The system was built to endure. You were built to be replaceable. When your term ends, another operator steps in. They pay the same deposit. They sign the same lease. They inherit the same building you improved. And the rent keeps flowing, without a pause. So here is what you were really looking at, the entire time. You didn't buy a restaurant. You bought a 20-year job, collecting rent for someone else. You bought the right to work the land. And you are the only one here who can be evicted. The arches were never yours to keep.